Today on Focus on Investing, the Nasdaq falls into a bear market. Is it time for you to start using bear market strategies? Let's find out. Time to get focused.
Time to get focused with Focus on Investing.
Gather around, hustlers. That's if you're still living. This is Focus on Investing. I am Focus, and this is your weekly stock analysis review. Here at Focus on Investing, we use technical analysis to give you a better insight to understand what's happening in the markets. If you would like to know why we use technical analysis as opposed to fundamental analysis, check out our video on technical versus fundamental analysis. If you saw our last video, we analyzed the Nasdaq Composite Index, and we discovered that the Nasdaq Composite Index was actually a bear market. Now, the Nasdaq Composite Index is a capitalization weighted index of over 3,000 common equities listed on the Nasdaq Stock Exchange. So that means it's not the Nasdaq Stock Exchange itself. However, it is a barometer of the Nasdaq Stock Exchange because it has over 3,000 common equities listed on it, right? So it's kind of like an indication of the Nasdaq index, right? But it's not actually the Nasdaq index. So today we're going to analyze the actual Nasdaq index and see if the Nasdaq index is a bear market. So first of all, let's take a look at what is the Nasdaq. The Nasdaq is a global electronic marketplace for buying and selling securities, originally an acronym for the National Association of Securities Dealers Automated Quotations. So the key takeaways are the Nasdaq is an online marketplace for buying and trading securities. It's the world's first electronic exchange. It operates in 25 markets, 1 clearinghouse, and 5 central securities depositories in the United States and Europe. Most of the world's technology giants are listed on the Nasdaq. If we take a look at the top 10 stock exchanges in the world based on their market capitalization, we can see that the Nasdaq is number 2. So we can see that the Nasdaq is a major stock exchange when it comes to assessing the financial markets. So now that we know what the Nasdaq is and how important it is, let's analyze the index to get an understanding of the state of the markets. Here we have the Nasdaq, ticker symbol NDQ, also known as the US 100 Index, and this is the daily time frame. You can also see on here that we have our Focus on Investing custom indicators, which is our trend filter and our key daily pivot support and resistance levels. If you would like to get access to these exclusive custom indicators, then go to focusoninvesting.io. Okay, let's get into the analysis. If we zoom out a little bit, we can see that the overall index has been bullish since March 2020. We had quite a big dip in this COVID era around March 2020. This obviously was COVID, so we had quite a big dip. But prior to COVID, we can see that the market has been in an upward direction since maybe you could say maybe 2018. But in more recent times, the recovery from COVID has been good. And we can see that we have a strong bull market been going on since the end of COVID. If we zoom back into our more current time period, we can see that the market has been going very bullish with regular pullbacks as any market does. Utilizing our Focus on Investing trend filter, it gives us a clear indication on whether the market is acting bullish or bearish. If our trend filter is colored green, that means the market is bullish. And if the trend filter is colored red, that means the market is bearish. Now we can see that the market is mostly green up until this point, meaning that it's very strong bull market. However, there have been slight patches of red indicating spots of bearish activity. Again, this is very normal for any stock or for any market. We can never expect any market or any stock to go straight up in one direction without having pullbacks or corrections. So seeing these red patches is very normal in any market. Just because we see red patches and we see bearish activity, it doesn't mean that that in itself is a bear market. So we had continuous growth all the way up until the 19th of November. Let's zoom in. We can see that price reached a high here around the 16755 area. We found a level of resistance and price was unable to break that level of resistance. So we ended up in this small channel of consolidation being supported by this 15659 area. If we look, price rose up to our resistance level, was unable to break it, pull back down to our support level, attempted to retest our support level again. On a second time of asking, tried to break through our support level, was unable to do so, and then eventually did raise back up to our resistance level, creating this chart pattern here, which we refer to as a double bottom. A double bottom indicates price is trying to break through a support level on 2 occasions. However, it does not have enough energy, or the market does not have the desire to go lower. Therefore, the market has to reverse direction and head back to the upside. However, we see here, when the market hit the upside on the 28th of December, it didn't have enough energy or support or will from the market to break our resistance level. We saw a bit of sideways movement and a bit of indecision from the markets. If we look at the bars or the candlesticks in between that period, we can see that they're very small, having quite long wicks and short bodies, which indicates a sign of indecision from the markets. We had our last strong green bar here on the 4th of January. And then since the 4th of January, we've actually seen all red in our trend filter, indicating quite strong bearish action. If we take a look at our key daily pivot support and resistance levels, we can see that we have one resistance level here at our all-time high. We have another one just slightly below it, represented by this area of consolidation here, where price spent quite a bit of time at this area. We see another one here, which signifies the top of this resistance area and also acting as a level of support here for our first double bottom and here for the second point in our double bottom. We see another key pivot support and resistance level here, another support level here, another one here, and another one here. Our key daily pivot support and resistance levels are custom indicators from Focus on Investing, and you can see them represented by these small dots. The red dots represent support levels and these green dots represent resistance levels. The longer the row of dots, the stronger the support or resistance level is, and the more likely it will affect the market. If we highlight some strong ones, we can see this one here, again, is where price has formed a double bottom. If we highlight this one here, we can see this is where price formed an area of consolidation. And if we highlight this one here, which is our support level, we can see where current recent price has struggled to pass through. So after price falling through this 15707 level, we can see how quickly it fell to the downside. However, it was caught around this support level and this support level here. We can see that these previous historic levels are where price is either rested or actually slowed going through. So once price did face this downturn, it actually came to rest here at this support level of 14096. Now, why is this level key? If we zoom out in the charts, we can see that this is the area that price recovered from after COVID. We can see at the 17th of February, this acted as a resistance level. Price fell once again and then came back up to this key level around the 14th and 15th of April. We can see that price once again pulled back from this area and tried to make a double bottom shape. However, on the 24th of February, price was unable to hold at this support level and fell right through. Now we know that the market is being heavily affected by the conflict between Russia and Ukraine. And this time period is where the conflict actually commenced. We saw all of this time period from the beginning of the year was where there was uncertainty in the market as to whether there would be a conflict between Russia and Ukraine. And we know that the markets generally do not like uncertainty. A lot of financial analysts calculate price on predictions of the future. And when we have uncertainty in the market, it makes it hard for analysts to predict what the price might be. Therefore, we see a lot of uncertainty in the market and a lot of downturn in the market. We know that the promise of war generally means a great decline in the markets. So this is why we've seen this massive decline in price from the beginning of the year. And then we can see quite messy price in the interim period while we were still pondering whether the conflict between Russia and Ukraine would actually take place. Once it did start to take place, we saw a massive decline in price at this point. But what is significant about this point that price stopped at? If we look at where this bar did actually stop, we can see that it's right by our key support level. If we draw it in here, we can see why price failed to break this area of support and the significance of support levels. If we go back in history, we can see why this area is key. Historically, we can see that it held as a support level here, here, And we can see that it acted as a major area of consolidation here in this area and also in this area here. So this is why we use technical analysis, because what has happened in the past is likely to happen in the future. And we can use historical data to help us understand and predict what price will do in the future. This is also why we utilize our focus on investing key support levels, because this will highlight levels of support and resistance in advance to let us know what price may do in the future. If we go back to the current time frame, we can see that price actually held at this level and recovered back to our resistance level here at around the 14035 level. This is a good sign because although price is very bearish, we can see that it does not have a willingness to fall further to the downside. And price has come back up to this area here and created a small area of consolidation right at this resistance level. Now, the main indicator that we want to focus on today is our moving averages. This is a significant indicator today on us analyzing and assessing our bear market. If you want the full in-depth breakdown about utilizing the moving averages and the importance of the moving averages, then subscribe to our channel for our upcoming video on moving averages. To give you a brief quick overview of the moving averages are these three lines here. We have the blue line, which is the 20 simple moving average, the yellow line, which is the 50 simple moving average, and the black line, which is the 200 simple moving average. The moving averages represent the average of price over a given time frame. So the 20 simple moving average is the average price over 20 days. The 50 simple moving average is the average price over 50 days. And the 200 simple moving average is the average price over 200 days. Why are these important? Long story short, it's important because it lets you know whether price is trading above or below its average over a given number of days. If price is trading above the moving averages, that means price is bullish. And if price is trading below the moving averages, that means price is bearish. And if price is trading alongside the moving averages, generally it means price is moving sideways and is in a consolidation. The relationship between the moving averages is also very important. Whether there is clear space in between them or whether they are crossing over each other is very important. And this brings us to today's analysis. In a bull market, we like to see that the moving averages ordered from fastest to slowest. Or in other words, the moving average with the shortest time frame should be at the top and the moving average with the longest time frame should be at the bottom. So in a bull market, we should see the 20 simple moving average at the top, the 50 simple moving average in the middle, and the 200 simple moving average at the bottom. Whenever one moving average crosses over the other, it indicates a change in direction in the market. Now right here is what we call a death cross. So what is a death cross? The death cross is a technical chart pattern indicating the potential for a major sell-off. The death cross appears on a chart when a stock's short-term moving average crosses below its long-term moving average. Typically, the most common moving averages used in this pattern are the 50-day and the 200-day moving averages. So what are the key takeaways? The death cross is a technical chart pattern indicating the potential for a major sell-off and has proven to be a reliable predictor of some of the most severe bear markets of the past century, including 1929, 1938, 1974, and 2008. The death cross appears on a chart when a stock's short-term moving average, usually the 50-day, crosses below the long-term moving average, usually the 200-day. So just to reiterate, it has proven to be a reliable predictor of some of the most severe bear markets of the past century. So with that in mind, now that we know what a death cross is and we know what the moving averages are, let's go back to analyzing the chart. Once again, we can see that we have our three moving averages. We have the blue line, which is the 20 simple moving average, being our shortest term moving average. We have the yellow line, which is our 50 simple moving average, which is also a short term moving average. And we have our black line, which is the 200 simple moving average, which is our long term moving average. If we ignore the blue line, which is the 20 simple moving average, and just focus on the 50 simple moving average and the 200 simple moving average, which is our key moving averages, we can see that here, the 50 simple moving average has crossed below the 200 simple moving average, indicating a death cross, which confirms our bear market. Now, if you're a member of our Patreon on focusoninvesting.io, you would have known that I predicted that we will see a bear market on the 28th of February. So I was 1 day out of my prediction. We actually saw it on the next day, which is the 1st of March. And this is the day that we saw our death cross. So the death cross is an indication of a bear market. So now at this point, on the 1st of March, we can officially say that the Nasdaq US 100 index is a bear market. So is it time for you to start implementing bear market strategies? Well, not so fast. And why do I say not so fast? Well, there's one thing you have to understand about technical analysis and technical indicators. There are two different types of indicators. There are leading indicators and lagging indicators. Leading indicators allow you to predict where price will go, and lagging indicators confirm price action for you. And the moving averages are actually a lagging indicator, meaning that the moving averages actually confirm what price has already done. So us looking at the death cross on the moving averages is price confirming that the Nasdaq US 100 index is actually in a bear market. But as I say, it's a lagging indicator. So as previously stated, how the moving averages work, they respond to what previous price action has done. So this death cross here is really a result of price movement back here. We know that the 20 simple moving average, which is this blue line, represents the average over the shortest amount of days. Therefore, it will move the fastest. So this is why we see the blue line drop the quickest. The next fastest moving average is the 50 simple moving average, and it drops the second fastest. And this drop of the 50 simple moving average is what's caused this death cross. So this drop with the 50 simple moving average is actually representative of this price movement here from the 5th of January to the 28th of January. So this is telling us during this time period, the market was definitely in a bear market. However, if we look at this time frame post the 28th of January, we can actually see that price is not in fact moving down, it's moving sideways in this mini consolidation. Yes, we saw price break down here in a mini fake out, but then it pulled straight back up into this area of consolidation. So although price has been confirmed as a bear market, this is referring to this previous price action and not current price action. Because these are lagging indicators, these indicators are not reflecting current price action. So although we're in a bear market, price itself is not actually currently bearish. Price is actually consolidated or moving sideways. And what will happen if price continues to move sideways, these lagging indicators will start to reflect this sideways movement and start reflecting the averages of price in this sideways movement, right? So currently, price is bearish because it's below our most recent high around this level. But after a certain period of time, this area here will become our new normal, and then price will no longer be bearish relative to our current price level if it stays at this level moving sideways, right? So although we're in a bear market, price is not bearish, and if price continues moving sideways over time, our moving averages will level out and we will no longer see a death cross, and we will see the moving averages moving parallel to each other, which will no longer signal a bear market. In order to continue considering this market as a bear market, we would need to see price continuing downwards to maintain the reverse order of our moving averages, which is the 20 simple moving average at the bottom, the 50 simple moving average in the middle, and the 200 simple moving average at the top. Now, although price is moving sideways currently, this may be a minor pullback. As we say, price never moves in one straight direction. So this may be a bearish move, a pullback, a bearish move, a pullback, and then price may continue to be bearish, in which case we can continue considering this as a bear market. However, if price continues to move sideways, this will no longer be a bear market and it will be a consolidated market. Or if price normalizes throughout this Russia and Ukraine conflict, we may see this just be one big double bottom, and price may return to its previous resistance level highs around here. As previously stated, markets do not like uncertainty, and now we're in the certainty of war. Maybe the markets will absorb the uncertainty and normalize itself and return back to normal levels. So just to reiterate, we are in a bear market, but price is not currently bearish. So as trend traders, we can't actually say that the trend is bearish. And therefore, I personally will not be implementing any bearish trading strategies at this time. Now is the time to implement patience and wait for trading opportunities to open up in order for us to get into the market and make money. Being a good trader is as much about acting at the right time and picking the right trades as it is standing aside when there are no opportunities in the markets. If you wanted to gamble, you could gamble on a pullback strategy, riding the market back to its all-time high level. However, that would be a gamble and that would not be strategic investing. Strategic investing says we stand aside and wait for a trading opportunity to appear before we put our capital at risk. Moving averages are just one element of our trading strategy that we utilize in order to analyze the markets to see a prime trading opportunity. If you would like to learn all the elements and the indicators that we use in our complete trading strategy in order to pick the best trades and protect your capital, especially in this time of uncertainty and with the looming possibility of a bear market incoming, and in order to learn bear market strategies to extract profit from the market, then go to focusoninvesting.io, where you can learn our full investment syllabus, where we break down each element of our trading strategy, teach you all the indicators that we utilize, including our custom coded indicators, which will also give you access to these custom coded indicators, and this will give you an edge up on the markets. Don't get caught out by all the news, noise, and confusion at this time of people telling you it's a bear market and that you should be entering into bear market strategies. My aim here at Focus on Investing is to teach you the strategies and give you the understanding of the market so that you can make the right decisions, invest wisely, build financial freedom so that your money works for you and you don't have to work. If you found this video helpful, then hit the subscribe button and hit the like button and leave a comment in the description. Do you think the market will continue to be a bear market, or do you think that we will see a recovery to the upside and this is just a minor dip while we go through this conflict between Russia and Ukraine? And if you do believe that this will be a bear market, do you have bear market strategies ready to go in order to make money in this market? I'll catch you next time on the next Focus on Investing Stock Market Review.